We've been watching emerging markets and emerging economies weakening to some degree because of the stronger dollar and some of the trade fears. But again, some of the strength in the dollar was occurring prior to that, and we started seeing downgrades in China and other places. Certainly areas like Turkey, South Africa, Argentina have also been challenged. So some of it is just that. U.S. economic trends, though, are pretty robust and continue to be so. Look at some of the NFIB data on small business optimism. It's now a good time to expand for capital spending. The tax laws are helping on the capital spending side. So I think it's more overseas, less U.S. in terms of the data.
The question, Steve, is how resilient can the U.S. remain in the face of some global weakness in emerging markets, potentially in China? So far, so good. But how long does that last?
You know, I think the market has a lot to digest here. And remember, we got a nice push in 2017 from unexpected global growth. And that helped the U.S. It might have added a half a point to GDP. And now maybe that's coming off, at least from some emerging markets. But the U.S. may be more, and I think Tobias probably backed me up on this, more of a price maker than a price taker. We're a big part of the global economy. If we're going to grow above a trend, I think that's going to help overall global growth and hurt certainly some people. You've got to make some decisions here about which companies will be hurt by a little bit weaker overseas growth and which will be helped by a little bit stronger U.S. growth. The mix will change. We won't be unaffected by it, but it'll be a different kinds of impacts through different companies, industries, and sectors.
Tobias, obviously the markets, I was going to just open it up for you there. I mean, the markets have stalled out in the U.S. a little bit as it contends with, obviously, financial tightening at the margin. You have higher yields in the context of potential decelerating growth or uneven growth, at least next year globally. So what does that tell you for the prospects for the U.S. market at this point?
Well, typically higher bond yields, something we've been talking about, and kind of the rising of inflation as well, particularly on the wage side, is that you tend to see a little bit more of a shift towards value away from growth. You tend to see some of those kind of, and I would call trade-sensitive names in technology that really haven't been hit, kind of now starting to at least show up. But that's not where investors have been worried about trade, and they should be, because obviously things like China, IP, are going to be very front and center in any kind of negotiation between the American authorities and the Chinese ones. So, I think it is more around maybe some large caps over small caps. Interestingly enough, we just did a survey with clients asking what they thought, and they're a bit conflicted about their views. They think the market will go higher, but they think the U.S. will continue to lead over emerging markets, even if the dollar were to weaken, and that's not typical. They've raised a little bit of cash, but they like financials. That makes sense in a rising yield environment, but probably backing off technology is not a bad idea.
Steve, when we consider the international outlook and obviously this IMF downgrade, but also the news of late from the likes of Italy, does it change the view of likely tightening of monetary policy in those places as well, or will they just focus on core inflation data as opposed to broader issues and gapping up in Italian bond yields?
Well, I think there's two separate questions there, Wilf, and I think you know this as well as anybody, probably along with Sarah there, this idea that you have this question of event risk that has to do with Italy and maybe to a lesser extent Greece, I think are both issues that come on the radar. They end up being a larger blip on the radar than probably the actual size of the event. But that's a risk there. And then you have the other risk, which is what happens with rates over in Europe and beyond. And I think the trend and the conventional wisdom is probably right here. You have this very gradual end to easing in Europe, and sometime next year we might even get a rate hike. And I think that's part of what is propelling what's happening here in the States. Not only do you have a Federal Reserve balance sheet that is now down below $4 trillion for the first time. It's come down by some $270 billion. But you have an expectation for rates next year and this year, another hike in December, and at least 2 more hikes being baked in for next year. The good news here, I think, is that these higher rates end up doing some of the Fed's work. The Fed doesn't have to worry now that it's raising rates on the short end and it's being ignored on the long end. It's getting help from the markets. And by the way, that's how monetary policy works. So in a sense, this is good news for the medium term, but maybe a little nasty news for the short term.
So Tobias, you put out your S&P year-end target for 2019. 3,100, I think, is where you're at. So a small gain next year. What do you assume about Treasury yields with that kind of forecast?
So it's less important what we think, it's more important what our clients think and the investors themselves. So institutional clients think we're going to get into 3.5% to 4% by next year or the end of next year. And that, I think, caps what you can expect on PE multiples. It's really going to be about an earnings driver here, and we think earnings grow 6-7% next year. That's going to be able to keep the market going. But there's probably some near-term concerns. We had put out a few weeks earlier, we thought as much as a 5% pullback was likely as people started to understand some of the inflationary pressures that are building. This is all kind of normal stuff, but investors are kind of freaking. It's happening at the worst time of the year for them. People want to make money by year end, particularly the fund managers. Their bonuses are tied to it. And it's not the greatest time for them to get hit late in the year. So I think there's more of that type of positioning and pain issue going on, but it's a fairly normal environment. I think the big shock is why it took so long for the bond market to realize this, and all happened, I guess, during Liesman's vacation.